So we are already through the midway of 2022, and for all of y'all who have been tracking the markets or the major news, I'm sure most of y'all have seen that there has been a bloodbath on not only Wall Street but indices across the globe. This is a presentation of what has happened. On this slide, you can see what has happened until the mid-year of 2022. Now, can anyone over here tell me, when you see over here SPX 500, what does 500 stand for? Now, it's a famous index in the United States. So when you see SPX 500 or when you see Nasdaq 100 index, what does 100 or what does 500 in this case stand for? Let's try and make this interactive, so that it would be interesting for you as well. So when we say SPX 500, what do we mean by 500? Or is anyone aware about what is SPX 500? All right. So, yes, someone, okay. So, SPX 500, when we say 500, 500, it means the number of companies within the SPX 500. So, it is an index which is tracking 500 companies. Yes, absolutely. We have an amazing audience over here who's answering proactively. So yes, when you say 500, it means it is tracking 500 largest companies in the United States. For NASDAQ 100, it refers to primarily 100 technology companies in the United States that the index is tracking. So instead of investing in one particular stock, if you want to invest in US markets as a whole, you can directly invest in SPX 500. Now, that SPX 500 is generally considered as a benchmark index for the United States because obviously it is tracking 500 largest companies in the United States. So, definitely, it gives you a great picture of what is happening in the United States. Now, so far this year, as we can see, the index is down by 21% from its 52-week high, and the year to date return is it's at a loss of 19%. Now this loss basically is considering the dividends received. So if I do not consider the dividends received, the loss would be even more, just on basis of how much the index has fallen. Likewise, you can see Nasdaq has fallen much more. It's almost 30%. Even Russell 2000, which is tracking the small cap companies in the United States, they are also down by almost 23%. From the high, the loss is almost 31%. When it comes to European indices, again, they've also taken a major beating down from their 52-week high. But overall, year to date, the losses have been comparatively lesser when you see in comparison to the United States. One of the other indices that is, in fact, done pretty well this year would be UK 100. So this index has not fallen as much as the other indices. Even for that matter, Canada and Japan, these indices have not fallen as much as we can see for the United States, or for that matter even the European indices. Now there's a reason why they've not fallen as much. We would be covering this in the latter half of the presentation. Now, if I were to move forward and take a look at some of the key stocks in the United States, most of them, like look at it, these are all blue chip big names. You have Netflix, which is down like literally 74% from its high. If you've heard about Nvidia, it's like the leading semiconductor stock that is down almost 60%. Airbnb is again almost 60% from its highs. You have Salesforce, which is down 45%. Starbucks, these are all big names that we in fact are personally using most of these companies on our day-to-day basis. You have Amazon, you have Apple. I'm sure many of us over here would be users of iPhone, or probably would be even seeing this presentation on their Mac or on their iPhones. You have Microsoft, which is down 26%, Bank of America, which is down 37%. So these are some of the big names out there which have lost a key portion of their market cap in the last 6 months. Now let's understand, before I get forward, quickly, if you all could just give me two key reasons, or two or three key reasons why have markets corrected so much this year. What has been the factors responsible for the fall in the markets this year? Just quickly, like the main key bullet points, that what caused this kind of a massive fall in the markets this year. Well, there's someone asking if we would be covering cryptocurrencies in this presentation. Well, no, we would not be focusing much on cryptocurrencies. It would primarily be about, how do markets generally react during recession, and how can you devise your portfolio or your strategies this year to deal with recession. Of course, there could be a small intro on what would be the impact of recession on cryptocurrencies, or the impact of rate hikes and other things on cryptocurrencies. But otherwise, in general, the presentation will not be focusing on cryptocurrencies, if that is your key interest. Well, yes. So we have others mentioning over here that it was COVID and raw material price rise, which caused the markets to fall, which is to a great extent, this is the primary reason. We've seen, when you say raw material price rise, it's not only the raw material which has seen an increase in prices. It's basically inflation, that is, the prices of almost each and every good or in every item, especially energy. Like, you have oil prices which have gone up to the roof, you have other commodity prices. That's why someone has clearly mentioned raw material prices have gone up. Now, if you can see over here, this has been the primary cause for the reasons why markets have witnessed such a huge correction this year. So, in the United States, inflation was at 9.1%. In the US, it came in at 8.5%. And in the Eurozone, it was 8.1%. So if you can see, this has been the fastest rise in inflation since 1980. Now, what is inflation? Inflation is nothing but a lot of money chasing few goods. So the demand is so high that prices have gone up to the roof. In this case, particularly this year, what we've seen, more than the demand, it is like the supply side related issues which have contributed to sky high prices and crazy amount of inflation. Now, because inflation is so high, we have central banks across the globe. What they have done is that they have started increasing the interest rates, especially the United States. In fact, it's not only the United States, across the world, interest rates have started moving up. Central banks have started increasing the interest rates. What happens is that it's a cycle. They believe that once the interest rates go up, automatically the consumers would be encouraged to save more and spend less. So there'll be less money chasing the goods, and that will automatically try and bring down the prices under control. Now, the biggest problem with this is that when you have the central banks increasing the interest rates, obviously, ultimately, the demand is going to slow down. And when the demand slows down, another risk that people face is there are recession concerns. What is happening is that markets are now fearing that probably inflation will still not easily come under control, even though the central banks are going for rate hikes. So we can actually see a scenario of stagflation. Stagflation is basically where your economy is not growing, and at the same time, your inflation is, skyrocketing. So that is a crazy situation wherein, on one hand, you have a problem of inflation, and on the other hand, you also have a problem wherein the economy is not doing well. So, generally, whenever central banks go for rate hikes, what has followed is, we've seen that there has been a recession in the following months. Now, we've been using the term recession to such a great extent. Also, I would just to show you this slide, like this is the MSCI all world country index. Now this is basically tracking more than 2,900 securities across the large cap and mid cap segments, and this year the index is already down by 20%, which has been one of the worst starts to a year on record since more than 1980 for that matter. So we've been seeing a massive correction since in the last 20 years. This there has not been any such correction in 2 decades. Even for Wall Street, when it comes to US indices, this was one of the worst the year has seen. Now, like I said, the biggest problem and the biggest fear that everybody is facing out there are recession concerns, and because of that, markets have already reacted. We can see the reaction by markets. The beauty about markets is that they tend to react in advance. So, although recession has not yet come, but markets have already priced in the negative impact of recession. So even if you see over here, this is how the assets have performed this year, and like you can see, most the volatility index this year has been up by almost 65%. You have natural gas prices, that is the energy prices, up again by almost 60 and 50%. These are the year to date numbers. Then you have dollar index. In fact, today it's up even more, so this number is much more than 9%. You have gold, for that matter, which is relatively flat for the year. And when it comes to the treasury markets, bonds have also not done really well this year. They are down by 14%. You have the S&P 500, which we already saw, is down by almost 20%. Even the MSCI all country index is down. So overall, FANG stocks, especially technology stocks, have taken a huge beating. They're down by 32%. This is true even when it comes to NASDAQ. We've seen technology stocks have taken a huge beating. Now, what happens is, for most technology companies, whenever you see yields going up, when yields go up, when I say yields, that is the interest rates. So whenever the long-term interest rates, like the treasury yields, go up, I'm just making it as simple as possible. So whenever the treasury yields go up, in the long run, it ends up being, in the short term, it is very painful for technology companies, because most of their valuations are based on what will happen in the future. Their projections are based on the future growth. So their valuations are based on most of these tech companies are not really profitable, and they are going to be profitable in the future. So when interest rates go up, their valuations take a huge beat, and that's when technology stocks suffer a lot when the long term yields go up. Now, we've been all talking about, like I said, the biggest problem in the room has been inflation across the world. The biggest problem has been inflation, and the way central banks are trying to tackle it, unfortunately, the only tool most likely that works for them and they have been using is to increase the interest rates. Now, if you can see over here on this chart, it already shows that there is a 40, I mean, almost an 80% chance. If I were to add all of this, there's almost an 80% chance that by the end of this year, the interest rate will be 3.5%. Okay, current interest rate is 1.75%, and by the end of the year, it is expected, there's an 80% chance that it will be 3.5%. There's a 20% chance that it will be 3.25%, but overall, so in fact, there's almost 100% chance that the interest rate by the end of December 2022 will be a minimum 3.25%. In fact, there's an 80% chance that it will be 3.5%. So this is what markets are projecting for the end of the year. And because of these rate hikes, we have started seeing recession fears. Now, I've been talking so much about recession. Now, what exactly is recession? Can anyone just share, like, what according to you is recession? what is the definition of recession? So what is a recession? When we say that there are recession fears, okay, firstly, before you answer this question, how many of you, I'm going to start this poll, how many of you foresee a recession in the next 6 months? Let's just see what according to you what are your predictions, that do you see a recession coming in the next 6 months? Okay, our poll is divided. We have some who think that yes, there will be a recession, some who think that there won't be a recession. Currently, it's 50-50. Let's wait for some more responses. I'm going to count for five and then end the poll. It's five, four, three, two, and one. Okay, and I end the poll. And yes, so majority of us do feel there's a 75% probability that we will see a recession, and 25% feel that there won't be a recession. So what is recession? Coming back, we have people over here. Okay, true, recession means there would be no demand for goods, almost true. But when it comes to the definition of recession, now recession is basically defined as 2 quarters of negative GDP. So if you have consecutively 2 quarters of negative GDP, that is when we actually term it as recession. So the first quarter in the United States has already seen a negative GDP growth of minus 1.4%. So now, if in this quarter, which is already ended, so if the numbers for the June quarter also come out negative, then that would ultimately actually mean that we are in recession. So, I mean, by the looks of it, it's not something that would be very difficult. It's quite possible that in this quarter itself, we see a negative GDP yet again for the second quarter, and that would mean that we are in recession. Now, there's a huge hue and cry about recession, but this is exactly what recession means. It just means 2 quarters of negative GDP, and there's a great chance that once we have these numbers out, we might already be in recession. Now, so since World War Three, we've had 13. Since World War Two, we've had 13 recessions, and three of them have been in the 21st century itself. That was in 2001, 2008, and 2020. Now, like I said, recession is basically defined as a period of 2 consecutive quarters of negative GDP. But in 2020, the world actually saw the shortest recession, which was there for only 2 months. Now, there is the National Bureau of Economic Recession who measures a recession, and the way they measure a recession is basically uh, the peak month, that is, like, for example, this is your best month of GDP growth, and the next month onwards, when the GDP falls, they consider that as the start of recession. And when the growth bottoms out and from there it starts rebounding, that month is considered as the last month of recession. So in if you all know, in 2020, between the growth dropped in Feb and it rebounded sharply after April onwards. So recession was considered only for the period of 2 months, that is from Feb to April. So that was the only exception that we saw in 2020. In all other times, on an average, recession was for many more months comparatively. So well, now when we see recession, what do you expect? Most likely, people believe that. What is your perception now? If there is a recession, do you feel stock markets will fall further just because of the fact that there is a recession, or do you think in the past when there has been a recession, markets will fall? A simple yes or no in chats would really help. If you foresee recession, I mean, if the US economy actually goes into a recession, um, what do you think has happened in the past? Have markets fallen further during recession? A yes or no? If markets have fallen, put in a yes. If markets have not fallen according to you, put in a no. Okay, great. We have some saying that yes, it has fallen. I'll wait for another um, 30 seconds before I move forward. Interestingly, there are some who have also said that no, markets have not fallen. Um, right. So, exactly, when it comes to recession and when it comes to the markets, so when it comes to the economy and stock markets, they may not always be in sync with one another. There are times when obviously markets are slow to react to the economic data, but more often than not, the stock market always front runs the economy. I'm sorry, it won't be always, but more often than not, stock markets do front run the economy. So just look at this slide and look at this data over here. Historically, whenever there has been recession in the past, like in the last 13 recessions that we've seen starting from World War II, markets during the recession period have actually gained an average of 1%. Isn't this really surprising? Because most of us generally feel that, okay, there's a recession and stock markets are going to crash. Uh, but what happens is that what has been seen historically, that markets generally tend to correct before there's a recession. So SPX 500 has bottomed out nearly 4 months prior to the end of recession, and in fact they have lost 6 months before recession. So equities often tend to do poorly in 6 months prior to a recession. So it's often observed that the index typically hits a high 7 months before the start of recession. So before recession actually even starts, markets correct well in advance, like 6 to 7 months prior to that, we see a correction in markets. And isn't it, I mean, to a great extent true for this year as well? We've already seen a 20% correction in like the MSCI World Index, country index, wherein we've seen markets correct by almost 20% this year. And one of the major factors contributing to the recession is obviously inflation, because of which there will be rate hikes, and because of that, markets have foreseen a recession. So the beauty about markets are that they always generally tend to react well in advance, and that is why even before we've seen a recession, there has been a great fall in the SPX 500, or for that matter even Nasdaq, that's lost almost 30%. And when we have our other stocks, so which have lost, like we saw, miserably, like almost 50% from their highs, even before the economy has entered into a recession. Of course, there's not only recession, there are multiple factors like rate hikes. We've had the Russia Ukraine war. So there have been many factors that have contributed to the sell off in the markets. So, does this mean that the worst is over? Well, no, nobody can exactly say that when there is a bottom for the markets. But if you look at it from a long-term perspective, if I were to share this data with you, and if you were to see that whenever there has been a recession in the past, on an average, if you see historically, and I'm talking about the last 13 recessions that have been analyzed. So, in those 13 recessions since 1945, if you would look at the performance following the 3 years after recession, the S&P 500 has gained an average of 30%. In 5 years, it has gained like 57%. And in 10 years after recession, it has gained almost 150%. So, from a long term perspective, markets have given amazing returns. So, when you consider a recession, in fact, from a long term perspective, it is these periods which are actually a great investment opportunity. But provided we manage it well, and it's, if you go all in and if you take in a lot of leverage, that will obviously be a lot of risk. So because you don't know when exactly is the bottom for the SPX 500, but you do know that once recession is over, markets will actually most likely bounce back, and in the long run end up giving positive returns. Of course, it goes without saying that there's no guarantee that what we see in the past will repeat in the future, but markets do work on, a risk calculative basis. So when you take when you invest in the markets, obviously you are taking on some risk, but it is a calculative risk. It's a thought on risk that we take when we enter the equity markets. So also, I didn't share this, but yeah, if you can see in a period following 1 year after recession, the average gain has been 14%. Although there have been two periods where the index has lost, but in the longer duration, when it comes to 3, 5, or 10 years, on an average, markets have always gained. Now, so does this mean the worst is over for markets, or will we see some more downfall? Well, nobody can exactly predict if there is further downfall left or no. But from the looks of it, we may see some more correction before the markets actually bottom out. But nobody, like I said, nobody can exactly predict where the bottom would be, or probably markets have already witnessed the max sell off. Nobody can exactly predict that. Having said that, the worst seems to be discounted so far. Markets are already pricing in multiple rate hikes by the Federal Reserve this year. They're already pricing in almost, like we saw in the previous slide, they're already pricing the interest rate at almost 3.5% at the end of the year. So most of it already seems to be factored in. But how inflation will pan out depending on the rate hikes is an important parameter that will have to be watched. And previously, whenever there has been recession fears or growth fears, Federal Reserve has not stuck to its rate hike trajectory that it had committed to. So it needs to be waited and watched as to how the Federal Reserve will react to rate hikes. I mean, to the inflation data that comes in, and to the GDP growth numbers that come in. But for now, they are sticking to the plan that they will go ahead with the rate hikes, and stick to focusing on bringing inflation under control. That is what has been stated by the Federal Reserve and other central banks also, for that matter. They have been committed to bringing inflation under control. Now, previously we've also seen, I mean, bear markets. When we say bear markets are when the index corrects more than 20% from their highs. So currently we are in a bear market, where, because SPX 500 for that matter has already lost more than 20% from its high. So the US markets are already in bear markets. Now, when we have seen bear markets historically in the past, so if you were to analyze bear markets in the last 80 years, like you can see over here, on an average, the markets have corrected by 35%. So, does this mean that we could see another fall, 10, 12% fall in the markets? Possibly, maybe not, maybe yes. But if I were to analyze what has happened during the last three recessions, that means since 2000, we've had three recessions. During that times, the markets lost an average of mere 16%. So currently we are down already 20%, and the average for the last three recessions has only been 16%. So maybe we've already lost out a lot already. So like I said, when it comes to markets, you cannot exactly predict where the bottom is. Ultimately, for long term investors, it will be important and necessary, that you are well positioned for expansions than you're trying to time your recessions. Of course, it goes without saying that you need to be well diversified. You need to focus on high quality stocks. We will be covering that in the presentation going forward. But when I say the last three recessions, so like you can see over here, uh, we saw a 8% fall in 2001. We saw 37% fall in 2009, and we saw a 1% fall in 2020 during the recession. Of course, the trough was much more. So the bottom fall could have been much more. But finally, between the start and the end of recession, the average fall was only 16%. Now, ultimately, what should matter to you is your long-term investment plan. So if you're looking from investing in the markets from a long-term perspective, this data is actually something. When I looked at this data, I was really happy when I saw that, all right, in the long run, markets are eventually giving out good returns. So probably a decent time to a decent opportunity to enter the markets. But how do you invest in these markets? The critical and the most important factor to understand that timing the markets is actually something that is very difficult. Now, one important fact that you can see is that even though there have been three recessions in the last 20 years, like since 2000, we've seen three recessions. Despite that, the S&P 500 has gained almost 300%. Like this does consider the dividends received and obviously reinvested. So we've made almost 300% despite recessions. So you need to understand that recessions are actually just mere bumps in the road. In the long run, if you are investing systematically, it will actually be beneficial for you in the long run. Now, also one important factor that needs to be considered and understood is that when we are dealing with inflation, the biggest problem is, of course, prices are going up and we need to deal with inflation. So if you were to consider from January 1926 till the end of 2020, inflation has grown like by 15 times. So something that would have cost just $100 back then, today that same thing would cost you $1,500. That's obviously a crazy number. But when it comes to that same $100, if it was invested in the US stock market, that would have grown to $45,000. So obviously, that is well enough covering for your inflation. That is what you need to understand. In the long run, a way to actually beat inflation would be through the stock markets. But ultimately, everybody is obviously trying to catch the bottom, and I cannot say it much more. We've covered it in our previous webinars also, that it is very difficult, and honestly it is futile to actually try and time the bottom, because markets are volatile, and when they're volatile, you do see a lot of up and down moves. But the biggest problem when you try and time the markets is that most of the best days for SPX are generally followed after the worst days. So let me ask you a question. The best day for, and in fact, I'll just do a poll once again. Now, the best day, single day return for SPX was 11.6%. From these dates, when do you think did SPX actually gain 11.6%? Was it October 2008, 13 October? Was it 2019, April 2019, or was it January 2020 before COVID started, or was it March 2020 after COVID was announced? When do you think SPX gained 11.6% in a single day? Okay, I'll wait for another minute before, I mean, another 10 seconds before I end the poll. So far, many of you think, surprisingly, that the best return has been on March 24th, 2020. Wow. Um, Most of us over here think it's okay. We have some who even voted for January 9, 2020, but it might surprise you. Now, many of y'all were very close. 24th March 2020 was the third best day for SPX 500, but the best day for SPX 500 was actually on 13th October 2008, which was 11.6%. Now, why am I sharing this data with you? It is important to understand that when we look at this data, you can see that the 10 best days for SPX 500 actually came when the volatility was at its peak, and when in during the years when markets fell miserably. You have October, most of the dates, if you see, it's all October 2008, March 2020, again March, April 2020, November 2008, November 2008, March 2009. So just look at this. Most of the best days have actually come during the time when markets are witnessing their most volatile time. And not only that, the key to understanding this, why am I sharing this data? The reason why I'm sharing this data is that if you were to miss out just the 10 best days in the market, it would actually cost you a lot. So for example, in the last 40 years, if the best 10 days basically accounted for almost 65% of the stock market return. In the previous 25 in the previous 20 years, the best 10 days accounted for almost 75% of your returns. So if you were to time the market and just miss out these best days, you would obviously miss out a significant portion of your returns. Obviously, nobody will only miss out the best days, because when you're investing, you'll also miss out the worst days if you remove your money from the markets. But what I'm trying to say is that when we're trying to time the markets, it's not necessary that you can exactly catch the bottom and exactly enter at the bottom and sell at the peak. That's very difficult, and even geniuses find it extremely difficult to do so. So again, if you can see, the value of SPX 500 rose almost 300% in the last 20 years. Uh, but if I were to just include those best 10 days, the number drops to 75%. So it's a huge proportion, if you could realize the significance of the same. Now, now the problem with timing the markets is, obviously everybody thinks that they can do really well, but what happens is that when you enter into the markets, you end up selling at the bottom, because obviously you cannot bear the losses. There's human psychology that plays a very important role. So we end up panic selling near the bottom. Of course, markets may fall further, and then you feel that great, it was a good decision to sell. But then when markets start moving up, you believe that no, 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 probably this is just a bear market rally, and then they'll start correcting further. And then when markets actually start moving up further, then we start regretting that, oh, why didn't I buy the dip? I should have bought the dip. And then you believe that, oh, probably we shouldn't wait further, otherwise I miss out more returns. And we end up buying nearly at the peak, and then again markets start correcting, and that's when we panic sell and probably sell again. So this is a common investor behavior cycle that has been observed. It's called as a cycle of fear and greed. Nobody can be blamed for this. It is our emotions that play with us, because obviously it's very difficult to see those kind of losses in our portfolio. So the way that we can deal with this, and the way that you can deal with all of this, is to understand the benefits of investing in the long run. Now, whenever, if you consider any 14-year period for the SPX 500 since the time of its inception, so it could be from 1940 to 1954, or it could be from 1955 to 1969, any 14-year period, there has been no negative return for SPX 500 in any 14-year period. In fact, if I were to see for any 10-year period also, uh, 95% of the times you would have made money. There's only a 5% chance that if you invested at a particular time, you would have lost money in SPX 500 if you were holding for 10 years. Obviously, if you average further at the bottom, the chances of that loss also reduces drastically. So for 5 years, the probability of a loss is close to 12%. The probability of a gain is 88%. Now, if you invest only for 1 year, the probability of a gain is 76%, and your probability of a loss is 24%. So, if you can see, the longer your duration, the probability of loss automatically comes down. So, when you are investing in the markets, try and invest from a long term perspective. So automatically, these are markets. We have to understand that in the short run they are bound to move up and down, but in the longer run, if you see, you'll always most likely SPX 500 and other indices for that matter have gone up in the longer run. Of course, there are always exceptions, but if you keep averaging regularly in a systematic format, and if your fundamentals are clear, and if your goals are set, and if they're clear, then sticking to a plan is what actually works out. So what exactly can be done? So this is a chart which basically shows that the longer you are invested in the markets, your probability of losing out money drops the longer you are invested. Now, obviously, when we are dealing with recession, everybody needs to understand that what do we do? How do we invest in markets? That's the whole idea and purpose of everybody being a part of this session. So, first and foremost, we have to understand that you need to maintain an emergency fund of at least 6 months of your living expenses before you start entering into these markets. What will happen is that when you have that much money kept aside, this would help avoid any kind of panic selling. And whenever you're seeing your portfolio lose, or there are losses in the portfolio, when you know you have some money set aside and nothing. And obviously, because if the world goes through recession, there is a great chance of our jobs being impacted and other consequences as well. Hopefully it doesn't happen to any of us, but when you have that money set aside, it gives you a sense of stability and does not let your emotions impact you drastically when you're dealing with the markets. Also, when you're investing in the markets, it's very important that your portfolio reflects your risk tolerance. So, say for example, if someone doesn't like to see, huge losses and does not have a strong heart for that matter, if that person buys a really aggressive stock, for example, something like Tesla, which moves to a great extent in a single day. So, if someone cannot witness a 10% fall in their portfolio in a single day, then obviously he or she should be avoiding a stock like Tesla, or for that matter, any kind of meme stocks or high beta stocks. High beta stocks are basically stocks which move much more on an average when compared to the S&P 500. So if the SPX 500 is moving up, say by 10%, and you have a beta of a stock which is 2, that means your stock will most likely move up by 20%. And for that matter, when SPX 500 falls by 10%, your stock will fall down by 20% if it has a beta of 2. So during such times when the markets are really volatile, investing in high beta stocks could see a lot of volatility in your portfolio. And to avoid the same, it's important that you stick to low beta stocks, or more importantly, stick to quality names in your portfolio. um, Companies which have strong balance sheets, which have a healthy cash balance in their account. These are companies that would be good investments when you look at your portfolios. Also, if you do not want to invest in individual stocks, investing in exchange traded funds, that is ETFs, or investing in index funds like we saw on the first slide, that we have various indices. So if you want to invest, you can directly invest in an index and not select a particular stock, because one particular company may not be able to do really well because of recession and may have to shut down. But if you're investing in 500 companies together, which is a representation of, for that matter, for the United States, then all those 500 companies will not be able to survive the recession. They can probably do really well. So when you're investing in the SPX 500, you're basically investing in indirectly in the United States. So in the long run, the US economy will actually come out of recession. And as we've seen in the past, SPX 500 has grown multifold in the last few years. Now, one important strategy that you should keep in mind is that during these markets, going all in will not be a good idea and a good suggestion. It's important that we stick to a ladder approach, or something called as a dollar cost averaging, wherein you invest a fixed proportion every month, or you invest based on the support levels for your indices, or for individual stocks that you are investing in. And obviously, it goes without saying, all your eggs should not be in one basket. We need to diversify across different asset classes. So, one key strategy is that we need not use much leverage when we are investing in such volatile markets. Um, just a thumbs up if you all know what leverage means, or if you do not know what leverage means, you can just type no in your chat box and I'll explain what leverage is. So I'm assuming most people know what leverage is. Now, before I move on to the next slide, I would like you all to take another poll, which would be about, I'm sure you all know about SIP, that is a systematic form of investment. So, if you were investing $1,000 in the SPX 500 since the year 1988, according to you, what would have that amount grown up to as of current date? $1,000 every month, you do nothing, just without any hassle, $1,000 every month in the SPX 500. How much, according to you, would that have grown to as of today's date? Let me tell you, this is approximately 40 years, so that would actually mean you have almost $400,000 of investments. I'll wait for another 10 seconds before I end the poll. So far, our numbers are divided. We have someone who thinks 500, someone who thinks 2.2, someone who thinks even 3 million. Wow, okay. Another 5 seconds. 5, 4, 3, 2 and 1, and that's it. I am ending the poll. So yes, our numbers are really divided, but for all those of you who actually clicked 3 million were bang on. SPX 500, in if you invested from 1988, your portfolio value would have actually grown up to $3 million. If you invested since 1992, it would have grown up to almost $2 million. If you invested for the last 20 years, you would have seen your portfolio almost increase to three times. And since 2012 onwards, if you invested nearly just $1,000 every month, your money would have easily doubled in that span of time. So, if you do not understand about markets, how to invest, where to invest, which particular stock to invest in, a simple and easy strategy that can be followed is just basic, plain and simple, $1,000 every month in the SPX 500. During the next year, if markets remain low the way it is, in fact, it would be a great opportunity to compile. But that is if markets give you that opportunity for so long. But otherwise, also in the long run, these numbers are visible to you very clearly. No matter where the market is, if it's at the peak or if it's at the bottom, every month diligently $1,000. If you would have invested, say for the last 40 years, the numbers are out there for you. It would have grown up to $3 million. Now, apart from that, we've already shared, and in fact even discussed in many of our previous webinars. All of those videos are available on YouTube. But there is something called as a ladder portfolio strategy. If you are interested in this portfolio, please reach out to your RMs or even me personally. I can share these portfolios with you. Now, what is this strategy all about? Now, instead of going all in into the markets currently, we would be investing. The portfolio is basically talking about investments in phases. So when it comes to dealing with such kind of markets wherein most stocks are trading at significant discounts, and you don't know what to do, like you want to participate in the markets, but at the same time, obviously there's a fear that what if there is further correction in the markets. So at that point in time, such a strategy comes into play wherein you do not invest all in. So if you want to invest say 1 million right now, in the first phase you just go for maybe 25%, so that is 250,000. When there is further correction in the markets, that means the stocks fall by 10 to 15%, or so on and so forth, depending upon the individual stock levels. You invest the next 350,000. And then in the third phase, when there's another correction in the markets, that's when you go and invest the remaining proportion, that is close to 400,000. So this way you are divided. And also the stock portfolio is such that it is divided between aggressive, moderate, and conservative stocks. When I say moderate stocks are generally stocks which have a beta of 1, that these are stocks that will move more or less in line with the SPX 500. Conservative stocks over generally are the ones which are not as volatile as the SPX 500, and they mainly consist of defensive stocks, such as your consumer staples. Now, these are companies that tend to do well even when there is a recession, for that matter. For example, if you need your basic day to day grocery, even if there's a recession, the demand for that is not going to fall. So these stocks tend to do well even when the economy is not doing well. So in the initial phases, our investments towards aggressive and moderate stocks will be much lesser compared to conservative stocks. But gradually, when there is a correction in the markets, we'll start increasing the exposure to aggressive and moderate stocks, and reduce the investments to conservative stocks. Now, if you want a detailed explanation on this portfolio, you can always take a look at it. Ask your RM to share the same with you. We've given an explanation on each of these companies, and you can look through it. Just contact your RMs, or even you can reach out to me. I can share the portfolio with you personally. Not only that, in case if you don't want to invest in individual stocks, and if you want to invest in the index as a whole, then we have this index ladder portfolio. And if you remember, on during the start of the presentation, I even spoke about a UK 100 losing really less, like nearly flat for the year. Now, the reason why it is flat is because it consists more of value stocks, and also a great portion of energy stocks as well. So the index did not fall as much as the other indices. So that is why when you're invested across the globe in different indices, your loss is much. It's the chances of a loss is much lesser. So if someone was invested only in Nasdaq 100, for that matter, the loss would have been uh, 30% so far this year. But if you were to invested in all of these indices together, the average loss for this year would have been only 15%. That is like 50% lower if you were invested only in a particular index. So, for example, Switzerland consists more of consumer staples and stocks like these defensive stocks. So again, it provides a decent amount of hedge to your portfolio. Likewise, you have France 40, Germany 40. Most of these indices have seen a significant correction. I'm not saying the worst is over for these indices. There could be some more losses, but that's when we would be capturing. And when we see significant corrections, that is when we would be averaging further, maybe on another 10 or 20% fall. So in the first phase we'll stick to only 20%, in the next phase 35%, and in the last phase 45%. Other things that can work well when, if and when there are recessions, are market neutral strategies. Now, these are some key strategies we have conducted an entire session on market neutral strategies previously. But we have some flyers out there, which are, now when I say market neutral strategies, it's basically, it talks about investing in two instruments that are correlated. And what you're trying to do is basically look at the correlation on these two instruments. And if, for example, the prices of these two instruments have deviated significantly, then you're expecting that deviation to reduce. So, a quick example, for example, you have Brent and WTI. Now, both of these are two different types of oil. Now, generally, the spread between Brent and WTI on an average, that means the price gap between Brent and WTI is on an average $5. Now, whenever we see this price gap falls down to, say, 1 or 2, that means Brent is now trading at, say, 100 and WTI is trading at 99. And generally, Brent trades at a $5 premium. So, when this gap is come down to just $1, it gives us a trading opportunity, because you're expecting Brent prices to go up much more than WTI, or you're expecting Brent prices to fall much less than WTI. You're not bothered about where oil prices go. All you're bothered about is the price gap between Brent and WTI. So, say currently the price gap is 1, you're expecting the price gap to go up to 5. In that case, you buy Brent and sell WTI, eventually expecting the price gap to come down to go up back to 5. If that does happen, you make profits on your trade. If it does not happen, and if it in fact falls further to 0 or less than 0, then obviously that would result in a loss. But historically, we've seen this has provided multiple trading opportunities even in the past. If you can refer to a webinar that I've conducted separately on market neutral strategies. You can look at that. It's available on YouTube, or even ask for a one-on-one session. I can conduct that as well for you. But if I were to just share this, like you can see this flyer, this was out on 14 Jan 2022, wherein the price gap between Brent and WTI was 2, and we were expecting it to go back up to 4 or 5. And that did actually happen in May, when prices actually went up, and the trade resulted in almost $10,000 profit, depending on your exposure. So, yes, these trades are available in the markets, and most of the times they end up doing well during volatile times, when you don't want to precisely target a particular instrument and target on the direction of that particular instrument, because there's so much volatility in the markets. Then market neutral strategies can be great ideas. We have market neutral strategies not only for commodities, but also for indices. There was one strategy that was worked out on KWEB, that is a Chinese index, versus HSCI. So that index is also, that strategy is also available, wherein you go long on the Crane Shares China Internet Fund ETF, and short the Hang Seng China A Share ETF. What happens over here is that the Crane shares basically comprises of technology stocks, whereas the Hang Seng ETF comprises more of stocks related to the consumer, when it comes to financials or healthcare and real estate. And that is one sector that China is putting a lot of what do I say? It's trying to ensure that the consumers in China, and the investors in China they start investing, they start you know they're basically attempting to reduce the cost of living over there, so that they're trying to reduce the imbalance between the different age groups, and the government is attempting a lot to reduce the cost of living. The common buzzword over there is common prosperity, so they're trying to reduce the cost of living over there. So it's quite possible that sectors such as healthcare, education, housing will be impacted. And also because of the real estate issues going on in China, the financial sector, which is a heavy weight in the index, in the Hang Seng index, is also facing a lot of losses. I mean, could face a lot of losses. So because of that, on the other hand, the technology stocks such as Tencent, Alibaba, which are a part of the Crane Share ETF, that index is expected to do well. So what this strategy is again about, it is about you investing in KWEB ETF and shorting the other ETF, which is the Hang Seng ETF. Now, when we are doing that, again, there is a flyer available. I have spoken about market neutral strategies previously, what is short sell and everything you can understand over there. But these flyers are available, and if you want a detailed one-on-one session, I can do that with you. But the key strategy is you go long on the Crane Shares ETF and short the Hang Seng China ETF. Basically, a long going long on the tech stocks in China. And these days, I mean, the regulations on China tech sector has started coming down, which is obviously a positive factor for the tech sector in China. So these stocks are benefiting. On the other hand, like I said, because the government is trying to bring down the cost of living, the Hang Seng ETF, the stocks in that ETF are likely to witness some slowdown. So that strategy could play out well. Since the time this flyer was released, that was at the end of last year, the returns have already been 5% positive. So again, one strategy that you can look into. There are many such market neutral ideas that we keep doing on our basis. I mean, it is something that is not available constantly, but we are on the lookout for such ideas and such strategies. So as and when you're interested, as and when these are available, we do suggest the same. And depending upon of course your individual risk profile and your investment goals and your investment duration, the trades can be considered. So overall, when we're investing in such markets, like I said, sticking to a dollar cost strategy or a ladder portfolio would be a great strategy. This can be a portfolio allocation that can be considered, wherein you're focusing almost 40% in blue chip index and ladder portfolio. And understand that in the first phase, you're investing only 20 to 25%. So remaining 40-50% will be lying actually as cash, and you would be investing only in phases. Then we have also bonds, which may be a decent strategy to start accumulating bonds from a long term perspective, given that the yields, I mean, the bonds are currently already yielding close to 3%, and the inflation, average inflation, is less than 3%, the 10-year inflation. So bonds may end up doing well from that perspective. And market neutral strategies are something I already spoke about. A great allocation could be to market neutral strategies. Also, you have defensive stocks, like I said, consumer staples and utilities. These are stocks that end up doing well during recession or during any economic slowdown. So these are stocks that can be considered in your portfolio. Also, dollar. The dollar itself is considered as a safe haven currency during a crisis. So even if you want to, just invest in the dollar, that could also be a good idea and a good strategy. Yes, that's it from my end for today's session. If you have any questions, or if you want a one-on-one session, please feel free to reach out to us. You can also review us on Google if you like the session. um, Sorry for exceeding the time, but you all have been an amazing audience. And yes, if you have any questions or any feedback, please feel free to share or ask. Like I said, your questions are coming directly to me. If you don't have any questions, then we'll wrap up today's session. And I look forward to seeing you all at our upcoming webinars as well. Yeah, I believe then we do not have any more questions. Um, thank you so much. It's great that you all liked this session. Um, we look forward to having you all us on other webinars as well. And the whole intention and idea is to create as much awareness as possible. And it's great that you all appreciated and liked the session. Thank you so much. Thank you, really. Thank you very much. Your comments are really motivating. Thank you for all the feedback. Please review us on Google as well.